Hi everyone, I'm Max Friar, founder and managing partner of Calder Capital. Before I begin today, Calder has closed nearly 400 deals in the lower middle market since 2013. We focus specifically on working with owners of manufacturing, construction, distribution, and service businesses that are in the lower middle market, and we specialize in maximizing offers so that our owners have the highest chance of receiving the highest price, the best terms, certainty to close, and a buyer that's the best fit for the future of their business. Today I want to talk about a couple of themes that are prevalent as we getting close to enter the second half of 2026. A lot of the things I'm going to say today might not be things that you want to hear, but one thing that I'm committed to is delivering the truth, telling you what you need to hear, not necessarily what you want to hear. First thing I want to talk about is buyer behavior. One thing that we've seen emerge in 2026 are that buyers are moving slower. They're very interested in doing deals, but they're not moving very quickly as they move through due diligence, as they analyze deals. And we believe this is strongly because they are trying to underwrite for a lot of different factors that have emerged over the past couple of years, including inflation, consistent higher interest rates, geopolitical tension, technology exposure, and AI. Essentially, there are just a lot of things that they have to consider today that they may not have had to consider before. So we'll get to the theme of preparedness, but essentially this means that sellers entering the market really need to be more prepared. Buyers are essentially heavily scrutinizing the durability of earnings of companies because there's been a lot of fluctuations in industries and companies' performance throughout the past few years. They're focusing a lot on customer concentration. They're focusing on owner involvement. They're focusing on management team depth. They're focusing on technology exposure. So there's many things that they're looking at when they're looking at companies. So a lot of this sentiment is showing up in market data. KeyBank recently released its Q1 report showing deal activity in the lower middle market, and it shows a comparison from Q1 of 2026 to Q1 of 2025. And what's kind of striking here is that for deals that are valued under 100 million, deal volume dropped 29%. Now that's a really impactful, large drop. Fortunately for Calder, we are keeping pace. So we just got finished with our 31st deal of the year. We are keeping pace with last year. Hopefully we can exceed that. I always want to win more. And I think it's really a testament to our team's performance that we're able to perform at such a high level despite all of these industry headwinds that have hit us throughout the year. So second theme I want to talk about is timing. When buyers are cautious, deals are taking a long time. I recently had the privilege of speaking with someone who represents a very large deal platform, and he was able to share themes they're seeing across hundreds of deals this year. So I'll use some percentages here to just give you an idea of how long deals are taking to get done once the LOI has already been executed. And I think this is particularly important because we receive inquiries all the time from sellers that say things like, well, I'd like a quick exit from the business in 3 to 6 months. That is likely not to happen. So what he told me is that 17% of deals are taking 61 to 90 days after the LOI is signed to get to the closing table. That used to be much more, it used to be the majority of deals, even probably 5 years ago, were getting done in that period of time, and now it's only 17%. 56% of deals are taking 91 to 120 days. While this might seem like a small percentage, a full 21%, so more than a fifth of deals are taking 121 to 150 days to close after the LOI is signed. So he also said, I thought it was kind of funny, he said if a deal closes in less than 60 days, his jaw drops because of how quick that is these days. So deal fatigue is real, and it's very important for advisors and M&A firms to focus on keeping their clients engaged, keeping momentum, keeping spirits buoyed, because owners can lose faith that anything is going to happen if the deal tends to drag on too long. I think it's wise to just educate your owners who you're working with that it's going to take longer often than they expect to close the deal. So finally, I want to talk about multiples. The good news is that for deals in this sub $100 million enterprise value market, the multiples are holding up relatively well. This is in sharp contrast to multiples for larger deals, which have taken a fairly significant hit across the board. What we'll do is we'll publish in the blog post associated with this video a table showing the change in multiples from 2025 to 2026. Now, to be clear, there has been some compression across industries, but it's not very dramatic, which is good. I think in closing, we are seeing a sharper separation of quality businesses versus weaker performers in the marketplace. Buyers have a lot of capital, they're very interested, they're flocking towards high quality businesses in industries like home services, construction services, infrastructure, healthcare, aerospace and defense, water treatment. If you think about it, a lot of industries where people have to go into fields and perform services, particularly with licenses, are very attractive right now. And I believe that's largely because those industries are less likely to be disrupted by AI. Last takeaway I'll leave you with is that preparation is everything. If you go to market with sloppy financials, if you go to market with poor record keeping, if you go to market with materials that are incomplete, you can't answer questions, the balance sheet doesn't balance, you're going to have a hard time. And in fact, you might not be able to sell at all if you're ill prepared. So at the end of June 2026, when we're filming this, if you want to sell your business in 2026, you're probably out of luck. That's not going to happen. But if you want to sell in the first half of 2027, now is the time to contact a firm like Calder to talk to you about valuation, to talk to you about preparation, and to talk to you about how the market is likely to unfold for that eventual sale in 2027. So I appreciate everyone listening to my speech here, and I look forward to talking to you. Please feel free to reach out. Thank you.